Without knowing this, you may think you're up for more tax depreciation claims than you actually are. Hey everyone, Tuan from Joy Tax here with another video designed to help you become a better property investor. When it comes to tax depreciation, you might not know it, but there's one key date you need to know about when it comes to purchasing a property. So make sure you watch until the end because you want to know how this might affect you and what you can claim on depreciation as a property investor. Now before we get into it, we want to be clear that this video is for informational purposes only. In no way should you interpret this as tax advice. We always recommend working with a qualified accountant or tax agent who can give you the best advice for your situation. So first things first, what does the purchase date of a property have to do with a rental property? Well, the ATO introduced new rules that dictated when a residential property investor can claim specific items within their rental properties. So here are the rules. Firstly, if you've purchased a property and exchanged contracts after 7:30 p.m. on the 9th of May 2017, you won't be allowed to claim any tax depreciation on second-hand plant and equipment. This is also commonly referred to as Division 40. Now be aware that this is different from claiming plant and equipment on your second-hand property. You can buy and install brand new plant and equipment like a ceiling fan or a washing machine for your tenants to use and still be able to claim it. But bear in mind that installing brand new goods for personal use while it's in your principal place of residence will disallow you from claiming depreciation if you decide to switch the property from your main residence to become a rental property. Secondly, if you purchased a property before 7:30 p.m. on the 9th of May 2017 and your property has second-hand plant and equipment, you'll still be eligible to claim depreciation. Here's where you can take advantage of these assets by getting a quantity surveyor like us to come through the property and survey the items for you to claim during your tax return. Regardless of the purchase date, claiming on Division 43, which is the building itself, is unaffected. This means that no matter what, property investors can claim depreciation on the building regardless of whether the property is brand new or second-hand. Things like the floor slab, the kitchen joinery, windows, doors, tiling, roofing structure, and even your retaining walls and driveways. If you want to learn more about the difference between Division 40 and Division 43, check out our video that explains this. The great thing about depreciation for Division 43 is that it generally makes up about 90% of the depreciation claims. So even if you've purchased after the 9th of May 2017, you'll still get great value in engaging a quantity surveyor to come and survey your property for a tax depreciation schedule. So there you have it. Hopefully that's given you a better understanding of what you can and can't claim depending on your purchase date. If after this you're still not sure, you can reach out to us and we can provide you with a free estimate on what you could potentially claim and which assets you can claim on. This means it's a no-risk option and we find the majority of property investors will definitely be able to claim pretty significant tax depreciation amounts on their property, no matter the age. Finally, if you have friends, colleagues, or even family members that would benefit from this video, be sure to share this with them. I'm Tuan Duong. I'll see you next time.